Welcome to our 12th Longview Conversations with podcasts. This is the podcast where we talk with investors in global financial markets, well-known economists, strategists from across the globe and geopolitical specialists, amongst many others. In this episode, I'm speaking with Kallum Pickering. Kallum is the chief economist at Peel Hunt. He regularly writes a column for the Daily Telegraph and often appears on various news outlets, including Bloomberg, CNBC, and the BBC. He's also written for the Spectator, the Evening Standard, City AM, and frequently interacts with policymakers, including the last Prime Minister's economics team. His specialist areas are monetary economics and real business cycle theory. And prior to joining Peel Hunt, he worked as senior economist for Berenberg Bank for almost a decade, covering the major advanced economies. And before that, he worked as senior economist for BNP Paribas. So let's dig in. Hope you enjoy the conversation. Welcome, Kallum. Fantastic to have you on the show. I appreciate you being here. It's great, great to see you.
Thank you.
So let's dig in. There's so much to talk about. You and I have had a number of conversations now, almost in preparation, but just an ongoing dialogue, I think, over the last few months. You kindly had me on your podcast, which was a lot of fun. A couple of months back, we talked a lot about deep dive UK stuff, and we're going to talk more global. We're going to talk more broadly across the globe, and I'm going to try and weasel out of you lots of detail and lots of opinions and lots of views. I'm sure that won't be a challenge. I know you've got a lot to say and there's a lot you think about. So let's start with the very super big picture. You kindly sent me a chart that I'm showing on the screen of the US dollar trade weighted index, a broad index in real terms, inflation adjusted terms, going all the way back to the sort of mid-70s, mid-1970s and so on. Why is it how does this fit into your big picture thinking? Why is it, what is it you want to tee up with this chart?
So let me just say, I like a cheat code. If I can, if there's something that consistently works over time where I don't have to do too many intellectual backflips, I like that. And it's funny because there are a few charts where they've just consistently given me an indication of where the world is heading. And actually, I've ignored them at my peril, where I've slightly overcomplicated it. And I should have just trusted that the chart and the long-term theme was right. And so this is one of my favorite charts. As you mentioned, it's the dollar index weighted against US trading partners, and it's inflation adjusted, which is important. And what this is a cheat code for, in my view, is flows of funds across borders. We can look at capital accounts data, current account data. Often in markets, we ask, where's the wall of money? But actually, if we just think about what currencies are showing us, they're just prices. If a currency is appreciating, money is flowing into that country. If it's depreciating, money is flowing out, which is why, well, we're in the UK, so just start with sterling as the example. Sterling depreciated after the Brexit vote, a signal that money was moving out of the UK. When sterling appreciates, it's usually consistent with good economic conditions and money flowing in. But the dollar is the ultimate safe haven currency, and it's for the biggest, most dynamic, most important economy in the world. And so what I'm asking myself when I look at this dollar index over a broad period is, what phase of a longer run economic cycle are we in? And what your chart shows is three peaks in this index on an inflation adjusted basis. One in the middle of the 80s, one around 2000, 2001, and one now, with three clear sort of pyramid shapes, let's call them. It goes up, then it goes down, it goes up, and it goes down. And the story that this chart shows, starting in 1979, is the dollar is weak in 1979, and the US has just suffered an extreme recession linked to the global oil shock, the last big OPEC shock of the 1970s. The US reacts by exploring hydrocarbons at home, oil discovery, gas discovery. It also responds with Reaganism, the deregulation, the tax cuts. So the US is trying to solve the problem that basically the world has. It's overregulated, we don't have enough energy supply, taxes are too high. And America benefits from this by solving this problem. the US shifts from a net importer of hydrocarbons to a net exporter. The tax cuts and the deregulation help growth. The US innovates, and the dollar starts to appreciate strongly, reflecting the fact that money is flowing into the US. Now, the dollar starts to weaken after the peak in the middle of the 80s, not because the US is doing badly, but because in a way the rest of the world is either copying or benefiting from what America has done in the early 80s. The UK's case, we had the deregulation, we had the Thatcher tax cuts, we had the pro-growth reforms in financial services. And so when the dollar peaks, US prices in markets are high relative to everywhere else. And just as prices look attractive in other parts of the world, you see these growth gaps narrow, you see these valuation gaps narrow. That process continues until the middle of the 90s, when the dollar in real terms hits a new low. Then from the middle of the 90s onwards, actually early 90s, forgive me, you start to see the first wave of tech innovation. These are all of the companies that we know. It's Microsoft, it's Google, Apple, and the dollar starts to appreciate dramatically. And what America is doing is it's innovating in internet and IT technologies, and it's starting to benefit. You get the dot-com bubble, you get the rapid growth in America. In around 2000, 2001, the dollar starts to peak. Then as money has flowed into the US has become relatively expensive. But then in the early 2000s, after the little correction in the US market, after the economic wobble, other parts of the world, peripheral Europe, emerging markets, the UK, start to do better. You see these valuation gap come down, and you see the dollar weaken in real terms, reflecting a reallocation of money away from US. Then you get to 2008. That's the new bottom for the US dollar. Since 2008 to roughly now, the US again has been the only game in town. Better growth, more exciting returns in stock markets, that's big tech. It's the second tech wave, and money has shifted into the US. So much so, actually, we've had about net $20 trillion money moving into the US since 2010 across all asset classes. We now have a similar level of the dollar in inflation adjusted terms that we had in the early 2000s and in the middle 80s. And you see three things. First, a big growth differential between the US and the rest of the world over the last few years. You see this outperformance of the US market on a relative valuation basis, and you also see this dollar peaking. And then when I look forward, what do I see is, where does this AI actually get used? Do we see the growth gaps narrow? Are other markets sufficiently attractive on a price basis versus the US? And I think we can start to say yes to these questions, in which case we're probably moving into a world where it's not that the US is the only game in town. The US is still very strong, but other stuff is sufficiently exciting and the US is sufficiently expensive so that we get a reallocation of funds.
Interesting. So this is sort of consistent with your idea, your point that you have a phase of tech innovation and then a phase of tech dispersion, essentially. Or you know, there's phases when America appears exceptional and phases when the rest of the world is catching up, essentially.
That's exactly right. The first phase of technological innovation is always the idea phase. And lots of countries are very good at coming up with ideas. Britain is exceptional, actually, at coming up with ideas. The tech ring around Cambridge and Oxford, we're very good at this kind of stuff. But America has the resources, it has the space, it has the energy. And so the innovation phase of technology tends to happen in the US, where you have the cheap energy, you have the economic security. But once that reaches its end state, the question is, who can then use that technology? The next phase is the proliferation, or in economic terms, I mean, we would say technological diffusion. And you know, the technological wave that we see now, of course, it's novel, it's new, but it's following a very, very predictable path. And the point I just highlight here is, when you innovate technologies, you need the brute force method of innovation. You need lots of energy, you need lots of resources. But the sign that you're heading to the diffusion phase is the technology is becoming smaller, it's becoming less resource intensive, it's becoming less energy intensive. And what the news around DeepSeek is signaling is that huge capex intensive cycle linked to tech innovation is probably not as necessary as we once thought. With DeepSeek and with the AI innovation, we're shifting to a phase where, on a unit basis, AI becomes less energy intensive, less resource intensive, but because it's cheaper and it's less intensive, it can be proliferated more widely. And so the paradox here is that even if we have less capex in AI specifically, AI capex more broadly actually widens. And with that broadening capex cycle, that's when you start to see the broadening leadership in markets away from the innovators towards the users. And when I say users, I mean services firms, banks, legal firms, consultants, even manufacturers that need to manage just-in-time supply chains. AI helps with all of this.
Interesting. So in other words, what you're suggesting is the reason for expecting the peak in this real trade-weighted, broad trade-weighted dollar index is because you know that DeepSeek almost indicates that you're moving from the intensive innovative phase to the dispersion phase. Is there not another argument as well that maybe I'm sure in some ways is consistent with this, but if I think of the early 1980s, it was a phase of tight money. And of course, tight money should drive a stronger dollar. If you think of the late 1990s, we had productivity strength and high bond yields and high interest rates as a result. And after both of those peaks, you saw a phase of monetary easing over the course of several years. Is that not part of the story?
It's a bit of a complication when you think about just the dollar, because think about it more broadly. Instead of monetary easing, I think I would put it as loosening of global financial conditions. This is something that we touched on actually in our last chat. When we think about whether financial conditions are easy or tight, the first place we look is the central bank. What's the policy setting? But as we mentioned, actually, most money is created by private banks in the private sector, commercial banks. So keep that in mind when we think about the overall situation for the dollar. The dollar is a unique currency insofar as it doesn't just reflect, say, interest rate differentials between the US Fed and other central banks, but it reflects the global appetite for risk taking. If the whole world is risk off, that tends to be a scenario where global financial conditions are tight. The willingness, the eagerness to take on a credit and extend a credit is low. Typically, when we're risk off, we want safe US dollar assets. When we're risk on, typically then banks are willing to extend credit. Private sector wants to take on a credit. You tend to see money flow away from the safe US market towards markets where, on a risk-adjusted basis, suddenly returns start to look a bit more attractive. And the anecdote for me that always comes to mind, and I think it's relevant when we think about the US economy in today's context. Remember 2017, when the Fed was signaling that it was tightening monetary policy, but you actually had the dollar weakening. Why was the dollar weakening? Not in inflation terms, in nominal terms. The dollar was weakening because we were becoming more risk on. We had the synchronized global upswing. And even though the US was the only country that had a central bank tightening in a meaningful way, the dollar was still weakening, which is not what textbook economics would suggest. You would expect the dollar to be strengthening because investors were saying, actually, there are opportunities returns outside of the US in this strong global environment. Then in 2018, the trend for the Fed doesn't really change. The US is really the only country that's tightening, but we had trade wars, which triggered this risk-off mode in markets and a rush back to the safe dollar haven. And then the dollar started to strengthen it. And so I think I'm inclined to agree with you, but I think I'd broaden it out to say there's a fairly strong relationship between global financial conditions and whether we're risk on or risk off. When we're risk on, financial conditions tend to be easy, and therefore the dollar is weak. When we're risk off, financial conditions tend to be tight, the dollar tends to be strong. And if we're heading to a world where we can be excited about the proliferation of tech, what we're really saying is we can be excited by the returns that companies that can use this technology can potentially get. And so if I'm a risk manager at a commercial bank and suddenly I have a business that comes to me and says, I can, through some capital expenditure, raise my profit margins, improve my cost base, improve my productivity, actually that changes the way I view the risk of lending to that company. It also, on the flip side, changes the demand for credit from the perspective of the business.
Interesting. I mean, and of course, if you're dispersing productivity enhancing tech, you should be enhancing productivity growth, and therefore commercial banks are more inclined to lend into that. The other observation I'd make is after your peaks in the late 80s and in 2000, 2001, the following few years are consumer booms in the US, also in the UK, which I think is consistent with that idea that rather than tech dominating the cycle, falling rates or loosening financial conditions, as you say, is also generating some consumer strength with a credit cycle and a housing cycle and all that sort of stuff. Do you think about that in those sort of terms as well, or?
Well, in a sense, that if there's any purpose of a market economy, it's to serve the consumer. And the best way to serve the consumer, or the way the market serves the consumer, is by, through competition, forcing businesses to innovate to seek a profit. And so typically what you find is you go through a phase where profits rise through the innovation phase, and then you go through a phase where consumer incomes rise because consumers ultimately benefit from the innovations that generate the profits in the first place. And so I think that's completely consistent. The challenge that you have is, if you think about these longer run cycles, once you've passed the innovation phase and you're thinking about the diffusion phase and how much you can raise consumer utility as a result of the diffusion of these technologies, you're essentially halfway through these longer cycles, because the end of the consumer cycle is typically a proper recession, a business cycle downturn, often a financial crisis to varying degrees of severity.
Interesting. Well, I love all that. I think that's fascinating. I love the long waves in markets. I think there's a lot to be said for them. So just as we're peak in tech in markets in 2000, the dot-com bust 2000, 2002, are you suggesting that's where we are in global markets now? That we all know that 7 to 10 companies in the US dominate the market capitalization of the US, and the US dominates the global market capitalization. Are we going into a phase like the noughties when actually non-US equities started to outperform again for sort of 4 or 5 years? Would you buy that?
I think we have a clear pathway to that kind of world. And I think I would broaden that out to say not just non-US, but actually US small and mid cap, which has underperformed relative to the Nasdaq. The reason I'm hesitant is we've got maybe 6 months to a year of risks to get through at the global level, geopolitically, on trade, uncertainty around the near-term momentum in the US market. And so there's a risk here that we just stick to what works for a bit longer in markets, which is tech, it's strong dollar. And so it's often quite hard to call these, but the fundamentals, I think, paint quite a clear picture. I mean, I think it's easy to be... I should say what I'm not saying here. I'm not suggesting that you sell tech and you move into the stuff that looks cheap, because actually, if you were to sell tech 2000 at the top of the market, over the longer run horizon, that would have been a mistake. I mean, for the very best companies that are still around today, you would have been much.
That is very long term comment though. I mean, a lot of those stocks went nowhere for 10, 15 years. I mean, it took a lot of them 15 years to get back to where they started. So, that was a big bear market, the dot-com bear market.
That was a big bear market.
50% bear market in 2 years. You don't want to be in that stuff, presumably. I mean, not many people have a 10-year view.
Well, so there are a few differences here. The first difference is a lot of the companies that the market is so excited about are actually producing stuff and they have earnings. That's the first difference. The second difference is, of course, the 2001 episode was amplified by the Black Swan, which was 9/11, unfortunately. So that had a very strong effect on markets and the US consumer near term. The third thing, which is just the present situation, is that I am concerned about downside risks to the US economy, because I think you have this reinforcing mechanism between the US government issuing lots of debt to service huge deficits, pumping up domestic demand, which is adding to US equity market valuations. Equity market valuations at an all-time high mean US household worth is at an all-time high. Households then spend, at the moment, virtually every dollar that they earn. The household savings rate is in the low 3%. So normal rate might be around 5%. And this is all fine while ever the government can serve the deficit, while ever markets are high, and while households are confident. But outside of that narrow leadership within the US economy, you look at commercial and residential real estate, industrial production, trade, it looks as weak as it does in the UK or other parts of Europe. Yeah. And so I'm nervous that this process, this positive self-reinforcing cycle, could become a negative self-reinforcing cycle. So that's a bit of a caveat. But that, and this is really the key third point here, I don't see piles of excess lying around in the US economy. We don't have excesses of real estate. We don't have excess of capital investment. We don't have a situation where the move upward in US markets is done by a lot of gearing on the household side. And so we lose the present value of our savings. Okay, it hurts the consumer short run, but it doesn't cause any structural or systemic effects. And so I would hazard a guess that even if we get downside surprises near term, you don't have the underlying ingredients for a genuine cyclical downturn. And so in the end, what you'll find is, yes, there might be a nasty correction as a downside risk. You might get some downside surprises in the US economy, but the market and the economy will very, very quickly find its feet. The Fed will be able to go a little bit further with rates than the market currently expects. And then when we come out of it, what you'll find is the market then broadens its attitude as to where it can take on risk. And so I find that the setup is very, very different from the early 2000s, where you had that big correction in a lot of companies that actually didn't have earnings, were not producing all that much. And then you had this very unfortunate external shock, which amplified the economic effects. Of course, black swans happen every now and again. It's hard to call, but I don't see a similar dynamic.
That's very interesting, because that leads us nicely into the sort of second topic we wanted to touch on, which was really the global outlook for 2025 across the major regions of the world. And you started to articulate some views on the US, and I was going to tee this up with a chart that came off a comment that you made when we were talking, which is a great observation. That one or two people are making, but it's not common parlance out there. I mean, there hasn't been, as you said, a normal industrial cycle since COVID. And we can see that in the global PMI chart for manufacturing that we're putting up on the screen right now. Since 2022, it's pretty much always been below 50 since late 2022. Exactly. And of course, coming out of COVID, it had an enormous bounce after a serious downturn on lockdown. So when you think about the global economy, let's just finish off on the US, because you mentioned there's not a lot of excess. In that sense, the economy should be cushioned. But you've also mentioned in the past that there is a risk of recession, and not a central case, but clearly a risk. And it's fascinating as well that as we stand today, recording on the 27th of February, Thursday, yesterday, the US yield curve inverted at 3-month, 10-year. Part of the curve, which the New York Fed likes as a recession indicator. It's not inverted at 10s, 2s. It's not inverted in other parts, but and there's lots of reasons why there shouldn't be a recession. But in the context of a bit of a recession risk out there, can you sort of talk us through that in the States, and then we'll move on to the other parts of the world?
That's right. Well, so again, for me, the recession probably. And again, maybe I spell my base case out. The US has been growing well above its potential rate for best part of 2.5 years. The Fed thinks US potential growth is around 1.9%. I think it might be a little bit above 2%, but you can probably tell I'm a productivity optimist. But almost by definition, if you think potential growth is, let's call it 2, and you at full employment have been growing at 3 for a while, if you really believe your potential growth forecast, you will undershoot eventually. Otherwise, your potential
Yeah.
growth forecast is wrong. And actually, if I have one wish, it's that that potential growth forecast is wrong. I'd much rather be surprised to the upside than to the downside. I'm not hoping for a US recession. But if we were to see that dynamic unfold, keep in mind a couple of things. First, it probably doesn't come from the parts of the economy that are already weak. Residential, industrial, trade. It will come from the parts of the economy that are strong. And the parts of the economy that are strong, whether that's consumption, whether that's financial markets, whether that's government spending, they're abnormally strong. That is to say, consumers aren't saving as much as they normally would under normal times. Markets are overvalued relative to normal levels. The US deficit is structurally very, very high. And so it's easy to imagine a world where if any of these three things just normalize, you're starting to lose momentum. I just highlight that over the past few weeks, we have seen consumer confidence surprise to the downside, measures of services activity surprise to the downside. The PMI actually for the US on Friday was below 50. Some of the manufacturing data have picked up in the last couple of weeks, but it's not clear to me that that's not manufacturers just stepping up their orders to front run trade tariffs. We've also seen, and I pay attention to this, the Atlanta Fed's GDP Now estimate has fallen in Q1 from almost 4% annualized to close to 2% annualized. And tomorrow we'll get the updated estimate, which doesn't factor in the downside surprises we've seen this week. So we might actually be looking at a Q1 estimate from the Atlanta Fed that's below 2% annualized, which is an appreciable slowdown versus where we've been. But then there's just a more fundamental point, which is so much about economic activity in the business cycle is down to the spontaneous urges that we have to spend and invest or to save and be defensive. And in that sense, sentiment is always offside relative to fundamentals. We're either much too optimistic or we're much too pessimistic. That's normal. It's human nature. I'd just throw in a little comment that most bubbles don't pop and most bubbles create more than they destroy. So I'm not anti-bubble. It's just to say that what you're seeing now is a world in the US where we're above potential, confidence is riding high, there are some artificial elements, and there's not much consensus that we need to worry about downside risks. And so the scope to be caught out, I think, is quite high. And we have seen over the last few weeks a series of downside surprises. And because of this spontaneous component of economic cycles, if we start to see these downside surprises, exuberance can quite quickly turn into panic. And you'll recall last October, we had a couple of bad labor market reports in the in the US. And very quickly, market sentiment came down a significant level. Now, the economic data didn't prove to be as worrisome as people feared, but it just demonstrated to me that this confidence that we have can evaporate quickly. And the scope for that to happen increases to the extent that confidence is offside relative to fundamentals. So I worry about this cyclical dynamic.
That's really interesting because and we'll come on to more of Trump's policies in a moment, but in detail. But clearly post-election there was a surge in confidence on the back of Trump getting elected and what he might do for deregulation, small business, etc. Now some of that's starting to fade. So how do you think of that confidence comment in the context of a soft growth patch? Was it a bit of a mirage what we saw from Trump initially, or is it just a longer term story? How would you contextualize that relative to the idea that maybe the US growth is going to disappoint to the downside this year to some extent?
Well, one of the traits of a market and an economy where the dominant mood is confidence and exuberance is that we too heavily discount bad news and we put too much emphasis on good news. And during the election campaign and initially after election and inauguration earlier this year, there was a big focus on all of the positive aspects of the Trump agenda, tax cuts, deregulation, but to a certain extent, a neglect of some of the downside risks. And there's an awful lot going on with the Trump policy agenda, and there seems to be some inconsistencies between the pro-growth tax cuts, deregulation, but then the anti-growth tariff policies. I think that we can actually thread a consistent theme through this policy agenda and say, imagine that Donald Trump for a second is not the US president being advised on policy by a bunch of economists, because they would have a very different view on trade, but they might agree with him on regulation and taxes. Imagine instead that Donald Trump is America's CEO. Then everything starts to look and make sense. So view this policy agenda through the eyes of a businessman. Lower regulation means I do all of the same things, but I do it with less cost. It's good for my margins. I pay lower taxes. That's good for my margins. I drive energy prices down. It's kind of drill, baby, drill. Again, I produce all of the same things at a lower energy cost. It's good for my margins. What about trade? Trump sees trade surpluses and trade deficits like a profit or loss on a corporate statement. And I think we can go one further. The story last week for a day, was it Thursday, was the idea that America might go to its creditors, its bondholders, and say, maybe we want to exchange some of these 5 and 10-year notes for 20 or 30-year notes. Well, that's a debt restructuring. If you take hold of a business that's got too much debt, the first thing you do is you lengthen your liabilities to provide you a little bit more breathing space near term. And so if you view all of these policies from the perspective as I'm running a business, I think they start to make sense. And I don't think there is actually an inconsistency. Even if I think that some of these policies are misguided, I think that you can draw this common theme.
Yeah. So your point about the confidence is simply that the market's slightly fickle. It emphasised the positives
Exactly
and now
right.
it's thinking about the negatives. But so since we're on to Trump, your idea is that really think of him as a businessman. I mean, it was interesting yesterday, the cabinet meeting that was televised, where they were talking about golden visas and charging $5 million for a golden visa with extra privileges, a bit better than a green card plus, I think they called it. So, and talking about the idea they might be able to raise $1 trillion doing that. If they sell enough of these. I mean, sounds like a bit of a stretch, but that was the figure that was thrown out there. That was very much a business Howard Lutnick driven. He's obviously a businessman, the Commerce Secretary now. But how would you extend, and I don't know how much you want to talk about geopolitics, but, those in Europe are kind of jaws dropped in the last couple of weeks when Zelensky was called a dictator. Trump had their meeting with the Russians in Saudi. The Ukrainians weren't there. The Europeans weren't there. A lot of jaws dropped in this side of the pond. And people were kind of shocked. Do you view that geopolitical side, and I think maybe you probably can, as a business transaction from Trump's perspective? I wonder how you characterize that and whether you put it in those terms.
I think there's 3 things that we should pull out of this. So we should discuss geopolitics, and then via the avenue of trade wars, let's get back to the global industrial cycle stuff, because I think there's a really interesting point to make here. Clearly, America's attitude about what it wants to achieve and can achieve on the world stage has changed. For better or worse, the world is now more multipolar. It may be, and this is my guess, Trump has concluded with the high deficit, with some of the economic challenges that America has, it just will not be possible for the US to maintain its economic position of superiority to such an extent that it can remain global hegemon, which means that the world is changing. I think if Donald Trump can get to a stage where the fighting between Russia and Ukraine ends, there's potential for markets, at least temporarily, to enjoy some relief from that. But then, of course, the detail will really, really matter. What makes me, I think, nervous is the precedents that might be set. So and let's start with the NATO alliance. America has provided Europe with a backstop on military policy for decades. And Donald Trump seems less willing to maintain America's position vis-a-vis Europe. So there's a challenge to NATO. There's a question about what the future looks like. And I just add here that on a lot of issues, Trump has started here, but he's very quickly come down to here. He's negotiable in that sense. There is an element of reasoning. And so Europe is going to have to spend more to shore up the defense on its eastern border, potentially without America's help. Trump is also making some unusual claims around things like Gaza and Greenland, even Canada, actually, kind of this 51st state idea. And so a few things come out of this. First, there's a potential risk that Russia's aggression towards Ukraine looks like a policy victory for Putin. There's a potential problem where if China, which is the big worry for the world and will remain the big worry, tries to, through whatever means, make a move towards Taiwan, on what basis can America actually make the claim that it should stand by Taiwan, given what it's saying about these other territories and these smaller countries? And to what extent would Europe say to America, we're prepared to back you with any China-related issues, given that you stepped away from your commitments through NATO on Europe? And so I'm not making any predictions here. It's just to say that from a market's perspective, we need to start understanding how future crises might unfold in a world where the international institutions that we have relied upon to provide us with a playbook for what happens next are being undermined. And so the crises happen from time to time, whether it's COVID, the global financial crisis, 2001. But these big crises have all happened within this framework of multilateralism. And even though we've been surprised by an event and the market has pulled back, the likes of you and I can look to these institutions and say, well, actually, there's a playbook for this. This is what America and Europe will do. This is how China will play a role. This is how America will conduct business with South America or with other parts of the world. And so what that allows us to do is provide bumpers against the downside risk, because at least we know what we think needs to happen next. And once you start to get the signals, oh, the Fed is about to do this, America is about to do this, we can start to reason our way to a recovery. If we go down the route of America not just threatening for the purpose of achieving certain ends, but actually undermining some of this framework around the world. And again, I'm expressing here tail risks rather than bets. What we have is a world where when the next crisis hits, markets won't have a roadmap. And we'll have to start figuring out what might happen next, because ultimately, if we have a global crisis, America, Europe, and China are all going to have to coordinate in order to solve it. And if you don't have a ready playbook that you can dust off, which is what these international institutions have been providing, then you're essentially starting from a standing start. And you have to figure out what happens, which amplifies the downside risks. And so when the world is doing okay, this is an environment where it's not ideal, but the world can still turn and markets can still go up. I worry about what happens if things go bad and we face a crisis.
But I would have thought, from a sort of a theoretical point of view and probably practical point of view, what you suggest, what you're saying implies that markets should have a higher risk premium because, There's ongoing geopolitical uncertainty. There's the institutional framework of the world is changing, and we don't really know what it's going to be. So that's an uncertain world that needs a higher risk premium. But it leads me on. So, is there not an argument feeding on from your businessman type theme that really he does? Firstly, I'd say he doesn't seem to like Europeans, or certainly not the European Union. I mean, some of the comments yesterday, you may not have seen them, but he talked about the EU trying to, I can't remember the exact words, sort of get one over on the United States. It was something like that, which I thought was an extraordinary term. And in the same conversation, he talked about how well he gets on with the Chinese president, how well he gets on with Putin. This is very, it's not odd for Trump because we sort of got a bit of it in Trump 1.0, but and he had that sort of that bromance with the North Korean dictator at the time, and who's still the North Korean dictator. So, but when it comes to Europe, I mean, if you take Trump as the businessman, surely what he's really doing, as you said, he wants to consolidate the public finances. He doesn't like overspending. So that's a goal. One obvious way to save money is to get the Europeans to pay for their own security. Isn't that a classic business transaction? They can afford it. Why don't they pay for it? They certainly ought to, in his mind, and it's hard not to agree with that sentiment. And so this is a great way to save money and contribute to cutting government spending in the States.
That's so. The difficulty with Trump is that on many issues he actually has a fair point. There are imbalances in the way America treats imports versus Europe and China treat imports from America, and these differences should be resolved. And the other thing which one needs to keep in mind is, and I just want to just take a couple of steps back. When we think about DOGE, the Department of Government Efficiency and the planned spending cuts, and the devil, of course, is always in the detail when it comes to this. But what the market is trying to figure out at the moment is what Trump's budget will look like. And yesterday, the House of Representatives at least passed the first draft, which involved 4.5 trillion in spending, in tax cuts, 2 trillion in spending cuts. Now, of course, it has to go to the Senate, then it has to go through the reconciliation process. But what I'm a bit, I would say, nervous about is, as far as I can tell, the tax cut component merely extends the tax cuts that were introduced in 2017. In other words, they're not adding to marginal demand. They're just preventing the US from jarring its own economy with taxes going up. So it extends the tax cuts, which means if the new component in fiscal policy in the US is the 2 trillion in spending cuts, that actually is a fairly significant fiscal jolt. So I think we should just keep that in mind. When it comes to trade and trade wars, again, just to use this business framework, shifting from the rules-based global order could be called something else, compartmentalism. That is to say, we don't allow certain issues to bleed into other issues. Take Brexit as a perfect example. Like, Brexit was never about the UK's role in European security. Even if you would have had the worst hard Brexit conceivable and the UK and the EU completely fall out, Britain's role as a major player in European security would have never been in question. That's that compartmentalization. Whereas Donald Trump, his approach is, no, everything's now on the table. I'll threaten you with tariffs in order to solve a problem that I think we have when it comes to geopolitics or military policy. So when it comes to Europe, I actually do think you already mentioned it. The two things are probably resolving this trade balance, which I think actually probably benefits America if Trump were to think long enough about it, but also military. Europe should spend more on military. I would say non-consensus call this year, my big one for the world is that trade wars at least in their acute form, the serious stuff that might present prominent downside risks to the world, I think this is going to be off the table basically by the middle of the year. And it's for some of the reasons that we've discussed. If you look at Europe today, you've had in Germany a 20% decline in industrial production since 2018. Russian gas doesn't flow cheaply anymore. You don't have strong Chinese demand. You have this strong EV competition. You have political disenchantment across Europe. So it's very different to 2018 when industrial production was at an all-time high. Russian gas flowed cheaply. Chinese demand was very strong. I look in China today and you see very clear signs of a liquidity trap. Growth is weak. Consumers are chronically lacking in confidence. You have lots of surplus capacity at home, which ideally you would like to turn towards exports. That's today. 2018, you had strong Chinese growth. Confidence was riding high. Beijing thought actually we might supplant America as the global economic hegemon just looking at our relative growth rates. Go back, take a look at America. Today, yes, growth is strong, but you have a big deficit. You have sticky inflation. You have this relationship between high markets and consumer confidence, which is vulnerable to downside and inflation risks that could come from trade wars. But in 2018, very different situation. Low deficits, low inflation, low interest rate, a US bond market that was still tranquilized by QE. America enjoying a cyclical upswing on Trump's deregulation and tariff cuts. And so tax cuts. 2018, US escalates from a position of strength. China, Europe are willing to play hardball on trade. And the only thing that intercepts the tit for tat escalation was COVID. Today, you've had this very sudden escalation in trade, but all three major players need this to be over soon, including the US, because they don't have the economic strength to wear a long trade war. And I think that's where we're seeing some signs. You mentioned it. Trump isn't playing as hardball with China as he did in 2018, at least not yet. When it comes to Europe, he's already offered Europe an out. Spend more on military, bring some down or harmonize the tariffs between Europe and the US, and we can avoid serious tariff deals. And so I think with all the bravado that comes with Trump, potentially underlying that is actually a recognition that America has some vulnerabilities and some problems. But it's not in Trump's nature to say, well, if we have these vulnerabilities and these problems, maybe we gently approach these issues. No, I think he's quite a risk-loving personality. I think he would prefer to escalate, get some deals, sell those to his base, and then hopefully within 6 months you'll have a few things. The end of trade wars, at least the end of fighting, potentially in the Middle East and in Eastern Europe. And then the market will grow in confidence about Trump. It will probably tolerate the tax cuts. We'll get some deregulation through. China will continue to ease. Europe will continue to ease. And then going back to the initial point, which is that industrial cycle that we've not had since 2018-19 starts to form in the second half of this year. And we should start to turn a bit more optimistic in some of the weak growth areas of the world.
Brilliant. That's fascinating. That's a nicely ties up where we started with a bit of China and Eurozone. So and presumably in that environment, you that feeds also what you said at the start with the dollar index chart, that it's peaking and other parts of the world are more interesting in terms of investments, as well as small and mid caps in the US are non-tech centric. And doesn't have tech in it, but a non-tech dominated portfolio globally might be a better way to go forward. I imagine you would regard that as consistent with all that.
That's exactly right. That's exactly right. And also just keep in mind that some very basic things, actually. The US imports about 10% of its GDP. In other words, 90% of its demand can be served by domestic production. Europe, Eurozone, UK, imports about 35% of its GDP. America's also a net exporter of energy. Europe's a net importer of energy. 2020, COVID, 2021, COVID disruptions, 2022, global gas supply shock, 2023, the echo of that, and the increase in global interest rates. For 4 years, we've had very abnormal global supply shocks, which have fallen heavily on trade-oriented and import-dependent parts of the world like Europe. America, being relatively insulated, has grown better than Europe through this period because it's less exposed to these risks. If you import 35% of your GDP versus 10% of your GDP, Europe versus America, global disruptions to shipping in 2020 and 2021 hit you more in Europe than in the US. It's not more complicated than that. If global prices for energy go up and you're a net energy importer, money flows from your economy, your consumers, to foreign producers. Whereas in America, you get a net inflow, you get this positive terms of trade shock, and any hit to consumer incomes from higher energy prices is just a transfer to your domestic producers. And so the money stays within the economy. So we've had a few abnormal things. We've had external supply shocks, which have pushed down European growth to virtually zero a couple of years ago. The US has done okay. You've also had the tech story in the US. You've had the government spending story. And then when you look forward, you say, even with trade wars, the global supply environment is improving. The global energy markets have adjusted, they're normalizing. Some of these demand side components in the US are starting to wear off. We're turning from innovation to diffusion on tech. So even if you go from a world where US growth is, say, 3%, European growth is 0, which is where we were in 2023, to a world in which European growth is even low ones. Don't be an optimist about European growth. Say it's going to be 1.5% and US growth slows to 2. That's a material reduction in that differential. That should show up in market valuations. And the story is a real economy one, which is the world is essentially normalizing. People need stuff, so we have to produce stuff. And if all of these shocks to global trade finally fade at a time when global policymakers are actually easing a little bit, or in the case of the central banks taking the brakes off, that should be consistent with an industrial cycle, a trade cycle, and a broadening market cycle.
Terrific, and that kind of feeds us into our last topic, which is that of the UK. And I'm just going to bung up the chart now of GDP growth since January 2020, showing that the UK, everyone had a COVID downturn, but of course the UK's had the poorest recovery, 6% cumulative growth since Jan 2020. Europe's doing better, and of course US is doing even better than that. So, two questions really. Firstly is what do you think of the cyclical position in the UK? How do you see the next 6, 9, 12, 18 months? Rates, inflation, the economy. And then second question, I think once we're dealt with that, is really, feeds off the productivity chart, the multi-factor productivity chart, which also I'm putting up, where we show that, really, and multi-factor productivity, I think most people don't really grasp. People think of labor market productivity, but multi-factor productivity, of course, is the real magic. With really 15, 17, 18 years of flattish, basically, no growth in the real magic of productivity. So there's a cyclical question there and a structural question. Cyclically, where are we going? Structurally, how do you fix the UK?
Cyclically,
big question, just to finish with.
So from a roughly standing start late last year, we will probably get a gradual recovery in cyclical momentum over the course of this year. And economic data since the start of the year have surprised to the upside, partly because expectations have just come down so much. I think we'll do well this year to get growth of around 1.5%. I think that's doable. I think we'll then get a little better growth heading into next year. Reasons are as follows. Bank of England has taken out some of the tightening, can probably go a little bit further. I think we'll probably get 2 more cuts this year. We've still got a little inflation that we need to deal with. So if bank rate can get to 4% by the end of the year, I think that would be a good result, hopefully further. You will see a positive fiscal effect. Let's not forget, although the budget did involve borrowing and tax hikes, it involved a greater commitment for spending on investment. So that will add a fiscal tailwind. The government is facing in the right direction when it comes to speeding up planning applications and deregulation. And I'm a bit skeptical of asking regulators to deregulate themselves, but the government is roughing up some of the regulators and has this idea that some of them should be combined. So at least I think the worm has turned in the right direction on the issue of overregulation towards deregulation. So when I put all of this together, rate cuts, bit of a fiscal stimulus, a little deregulation, from a position where the UK has lots of problems, but one thing it doesn't have is financial system problems or balance sheet problems. The banks are well capitalized, households, businesses have got good balance sheets, they've got lots of cash. You should start to see an improvement in economic activity. Now, one thing I just mentioned is the story that we just described for Europe has applied to the UK, where for more than 4 years, you've had external supply shocks holding back economic activity. And for that reason, expectations for what the UK can do in potential growth terms, I think have come down too low. I'm not expecting UK potential growth, say, to be 2 or above, but I think 1.5% is probably reasonable, maybe even 1.6, 1.7. I think anecdotally, my impression is, speaking to market participants, that potential growth may be 1 or even less. I think that's much too low. I think once we get back to normal levels of potential growth, we will have a better idea of what our structural growth problems are. And so I think in an ideal world, the UK doesn't have a balance sheet problem. It doesn't have a demographic problem, actually. Our population growth is fairly strong. The UK could be, if we get the policy right, a 2.5% growth economy. And so to be a 1.5, 1.6% growth economy means you're doing a lot of stuff very, very poorly. Now, we could do an entire podcast on what we've learned from the Labour government so far, but their major policy mistake has been to not inspire confidence. The UK does not have a physical problem, it has a sort of mental problem. We've had 10 years of bad policy, bad politics, bad economic shocks, and now we have a bad case of economic pessimism, kind of PTSD. So we need to work on recovering confidence. And last year we had really good growth at the first half of the year because confidence returned, because the shocks have faded. And then instead of the government inspiring confidence after winning the election, it was a bit too honest about the challenges and confidence tanked. We see actually in some of the data confidence is starting to pick up. So the cyclical story, I think, is okay. The danger, unfortunately, I think, is in April we will get a sudden increase in employer national insurance, so jobs tax. My hunch is, and we saw this in the latest inflation data, which surprised to the upside, firms have actually got a bit of pricing power. So they'll be able to pass this higher tax on to final prices because demand is actually okay. So we won't be worried too much about unemployment. The danger is actually, I'm overestimating how much pricing power firms have got. And when taxes go up, we see unemployment losses. So you jar the labour market, you jar the economy. But then I think that opens the door for the Bank of England to go a little bit faster. We would be worried less about inflation in that environment. When it comes to the structural issues for the UK, there are two things I think I would just emphasize. There are sins of omission when it comes to economic policy, and there are sins of commission. The sins of omission are the things that we haven't done that we should have done, and then the sins of commission are the things that we have actively done to damage our economic potential. So when you think about multi-factor productivity, so we're of course economists, so we like all of these somewhat nerdy terms, but multi-factor productivity as opposed to labor factor productivity is, are you optimizing the blend of factors of production, land, labor, energy, capital, in a way that maximizes your potential to produce goods and services for the benefit of consumers? And that chart that you shows a very clear positive trend right through the 20th century until about 2005, 2006. where it almost moves sideways. For all intents and purposes, for nearly 20 years, we've not raised our multi-factor productivity in the UK. This is a huge problem.
Mm.
The sins of omission, the things that we haven't done that we should have done is, we haven't realized, in my view, that the world has fundamentally changed. So our economy was built upon, our modern economy was built upon global financial liberalization, global trade liberalization, and actually a period of relative peace and geopolitical stability. And what you see is the last golden age of the UK is late 80s to the global financial crisis. And what you see through that period is the advancements in the European single market, the advancements in global trade, China entering WTO, you see dramatic deregulation of global financial services, and you actually see when the wall comes down, a period of relative stability. People forget, we unleashed an incredible amount of economic energy with the fall of communism.
Mm-hmm.
We also had a peace dividend where military spend came down from 4% of GDP to 2% of GDP. So we were able to spend on public services and education and all these other things without raising taxes. And that's when the UK had this burst of abnormally high economic growth and productivity. Since the global financial crisis, we have had a reversal of financial liberalization. In the UK specifically, we've had a much more risk-averse approach to regulation. We've forced banks to hold lots of capital. Again, I listened to our podcast from last time, and one of my favorite parts, and we discussed this last week when we caught up, was, okay, you can increase regulations for banks, and you can ask them so that they don't take malinvestments and unnecessary risks. Or you can ask them to hold more capital so that they can take whatever risks they like, but they have the capital to account for the losses. We've asked them to do both. So we've prohibited the risk taking, and we've asked them to take on the capital that would give them defense against risky investments. So we've had this overcompensation. When it comes to trade, global trade barriers have risen. We've left the EU, which has essentially meant that we've increased the barriers that allow us to access factors of production in Europe. And then much more recently, geopolitics has returned. And so part of what we just need to do in the UK is just start recognizing that the world has changed, and then allow our economy to adapt through a combination of market-based measures, but also through policy measures.
Yeah.
Then there's the sin of commission. And for me, this is the big one, and it's a piece of research which I'm working on at the moment, and will be out soon. The government is telling us consistently that there's no trade-off between economic growth and net zero. That is to say, the shift towards decarbonization and clean energy is not presenting an economic headwind. Okay, that's quite a bold claim. Let me see if that's true, was basically my question. Mm-hmm. I look then at the relationship between productivity growth in the UK, the long-run trend in productivity, and electricity availability. And what you find is UK electricity availability, and power is energy is a key factor of production, going back to our earlier framework. UK electricity, the available electricity to consumers and producers, peaked in 2005, and it's fallen precipitously since then by almost 20%. That coincides with rising energy prices, accelerated deindustrialization, and this kink in the productivity story. So while that's interesting, let me broaden out this question and say, what does it look like in the rest of the world? So I looked at data for 189 economies, per capita GDP, which is a proxy for productivity in a way, because productivity is the thing that raises living standards, and the measure for living standards is per capita GDP, and per capita energy consumption. And what you find is a strong positive correlation. Economies that have more available energy tend to be richer. And if you compare the US to the UK, and the US, like the UK, has been to a lesser extent, but still on the same path towards decarbonization and renewables, there's a very different trend between these two economies from 2005 onwards. Since 2005, America has basically been stabilizing its per capita energy consumption, but it's been raising its living standards. And it's been doing this mainly through energy efficiency. You know, machines give off less heat, the lights give off less heat, computers give off less heat, so we're wasting less energy. Whereas the UK, and again to emphasize, America has stabilized its energy consumption, but raised its living standards.
Yeah.
What we have done is stabilized our living standards and reduced our per capita energy consumption. That's a very different policy choice. And so to the government's point, there's no trade-off between net zero and economic growth. Well, actually there is. For 20 years, we have decommissioned gas, we've decommissioned nuclear and coal. We haven't replaced it with other energy capacities. Our electricity supplies have declined, and the effect has been and this is a huge achievement actually, we've stabilized living standards, but we throttled one key factor of production, an important factor of production. And so that's the sin of commission.
It's an interesting thesis. I have to say, I don't hear any companies, I hear a lot of people complaining about the price of energy. I don't hear anyone complaining about the availability of energy. I mean, we haven't had blackouts as they've had in parts of America and in California occasionally, and once or twice, I think, in New York. But so it's interesting. I wonder if it's which way the cart and horse goes. Is it more that the economy's not had productivity growth and not grown as much, and we've deindustrialized and we've become more of a consumer society, so we've used less electricity, and so the fact that there's less supply hasn't been an issue? Or is it actually the limit of supply is holding us back? I mean, I understand the price of energy is definitely holding us back, and that's linked to the amount of supply. I think that's the interesting question, because I think there's a ton of reasons why productivity is so weak, and that may well be one of them. Certainly the price of energy is one of them. I'm not sure about the supply of capacity of energy. Is that?
Well, so and to be clear, my claim here is not that this is the golden key that unlocks this is something that supplements this story. Yeah. Low interest rates, zombie firms, malinvestment, pre-GFC, all of this, of course, matters. But what the market mechanism does is regulate scarcity through prices. And as a result, then you get a rationing of supply and also a management of demand. And so
that's true. But just to push back, it's not pure market mechanism, the price of energy. It's government influenced. I mean, they've deliberately put prices on and set up a mechanism such that it will pay for the capex of the alternative energy. So it's not a pure market mechanism at all. It's a government regulated price in a large way, to a large degree. A bit like the oil price has got tons of taxes in it. I mean, electricity prices and energy prices have effective regulatory prices in them.
If you strip away those additional costs that policymakers impose, you still see this very sharp rise in the price of all types of energy, all types of fuel in the UK. What's striking is for the best part of 20 years until 2005, when you see this reduction, you see virtually stable energy prices. Some go up, others go down, but across the board, we have this stability. Then in 2005, when electricity availability comes down, when the UK, partly because of the reduction in extraction from the North Sea, becomes a hydrocarbon net importer, previously it was a hydrocarbon net exporter, you see this continued rise in prices. And I think on a unit basis, that is, for any given economic activity, we require less energy today. Totally right. But an easy check we can make as economists as to whether, when you know that demand is probably falling on a unit basis, but you also see supply falling, as to whether the supply declines are exceeding the demand declines, is what direction prices are rising. And so what you would have expected to see is, when you extract all of these artificial price additives coming from policy, is underlying prices remain stable.
But do we not have to be slightly careful on that front as well? Because the whole way the electricity system is set up is to price at the margin on nat gas prices. So it's not a sort of across the board all energy inputs giving us the electricity price. It's driven by the gas price. So it's a very peculiar market.
It's a purely market.
I don't know when that came into being, but it certainly wasn't the case 30 or 40 years ago.
This is why I look at the broader sample actually in this analysis, because every market, every country has its idiosyncrasies when it comes to energy. And so if you want to establish a plausible link between energy consumption per capita and living standards per capita, the easy way to do this is to kind of do a meta-analysis. And what you find is, if you look at countries where you could say, well, these are comparable economies, Korea, Germany, Poland, you see these very clear relationships where Germany and the UK, where we have been throttling our energy supply, are starting to underperform on a per capita basis. Places like Korea, where you've had this dramatic increase in electricity availability, you see a rapid rise in living standards. The other thing just to keep in mind is why this affects innovation. You know, when you're at the early stage of innovation, this, you know, there's this brute force stage of innovation. What you need is energy. So let's return to this AI. AI is different from regular software insofar as it learns, you don't teach it. You don't code it. So typical software, you need coders. The pace of advancement is just how quickly can we write code. With AI, it's how quickly can it learn.
Yeah.
And the laws of physics apply to a computer like they apply to any other machine. The more energy you can feed the computer, the faster the AI can learn, which is why in America, where you have low marginal energy costs on a relative basis, energy security, and of course the best institutional framework for markets and innovation, you have this AI boom. And it's also why in the case of the UK, we're very good at AI startups, but once they reach a critical size and they realize we need the energy security, we need the energy price, you move to America. The hopeful thing in all of this, and this is where, in a sense, policymakers are admitting my point. This year is the first year since 2005, if the government actually builds as it plans, where electricity availability to the UK economy will start to rise. And the government will, if it fulfills its commitments on renewable capacity and gas capacity, will increase the power available to the UK economy in every year right through to the middle of the century. And we'll end up with a higher level of electricity supply than we did in 2005. And with that, the government is telling us that prices will come down, the levies will come out, and you should start to see these economic effects, which is to say, if my analysis is right, and this is always the question, what should I expect to see? What you should expect to see is, if the government actually builds out this capacity, we should start to see some upside surprises in productivity over the next few years.
Well, I hope you're right. And I think I love to hear a note of optimism. I think that's a terrific place to conclude, because it's been a wonderful trip around the world, Kallum.
That's great.
Thank you.
Yeah.
Thank you so much. I appreciate it. And thank you for your time, your insights, and we'll reconnect another time in 12, 18 months' time, see where we're at.
Thank you so much. It's very kind that you had me on. I really enjoyed that. Thank you so much, Chris.